I think it's very possible that one of the reasons why gold is in this massive bull market, other than the fact that real interest rates are falling, is the fact that they're going to monetize gold by declaring it worth $3,000 an ounce, $5,000 an ounce, maybe much higher than that, and pay off our entire debt by printing money. Now, that's a very extreme case. I don't think it's going to happen. But could they revalue gold to a fair market value that's north of $3,000 an ounce? Yes, I think they could do that. And that would create a whole heck of a lot of inflation.
This is Little by Little with Andy Schechtman.
All right, everybody. Welcome back to another episode of Little by Little. And I'm thrilled that our guests just keep getting better and better. I've been following this gentleman, Michael Pento, from the Pento Portfolio Strategies for at least about 5 years now, trying to catch just about everything that he puts online. I'm very excited to have you here, Michael. I'm a fan, and thank you for joining me. How you doing, my man?
I'm doing fine, Andy. And it took you 5 years to ask me to come on the program?
Well, you know, I've
done I earned it. I hope I finally earned it.
Hey, you've earned it, but I've done about 5,000 YouTube videos on everyone else's channel over the last 4+ years. And in June, I started this channel. And we're up to about 33,000 subscribers since June. So it's an effort that is starting to gain a little bit of traction. After all of the years of speaking on everyone else's channel, I figured I'd give a go of it myself. So I would have had you on a long time ago had I been doing my own, but here we are, and I'm glad that you're here. I really do appreciate it. I'm looking forward to hearing your take on some of my questions, so we'll jump right into it. And let's talk about the current market dynamics first. I was watching or reading some of your stuff in preparation for this, and in one of your recent commentaries, you described the economy and the markets as a whole as being in the state of precarity. Could you explain that to my listeners, to myself? What are the factors that are contributing to this precariousness, and how should investors begin to navigate such volatility and precariousness?
Well, first of all, let's start with the fact that we've never had before a triumvirate of bubbles that exist concurrently. So we have a record bubble in equities, a record bubble in real estate, and an enormous credit bubble too. So if you look at the total non-financial debt as a percentage of GDP in the United States, it's 265%. That ties the record set in 2008. Now there's corporate debt, there's household debt, and there's government debt, state debt. And if you look at those debts outside of the banking system, they've never been higher, not in nominal terms only. They are extremely off the charts in nominal terms, yes. But even as a percentage of our phony GDP, it's at a record. So we've never had a bigger credit bubble than this. We've never had a bigger housing bubble than this, because if you look at home prices as a relation to incomes, I always look at things in a ratio. So I don't like you to say, well, you know, household debt is at a record high. Well, it is at a record high, but in relation to incomes, it is not. It's about 70%. It was at 100% in 2008, but it fell to 70%. But the average ratio, if you go back prior to 1980, it was like 40% of GDP. So it's still high, but it's just not at a record high. But if you look at the housing prices as a percentage of income, a record high. And of course, not in nominal terms, through the roof. And if you look at equity prices in terms of GDP, at a record high, 206% of GDP, never before seen, not even imagined prior to COVID. The average of that metric is around 90%. So you have three triumvirate bubbles: credit, equities, and real estate. And that makes for a very precarious situation, because you need a constant flow of hot air or a money supply flooding into the markets to keep those bubbles afloat. You need a banking system that's cranking out loans. You need a Federal Reserve that's cranking up its balance sheet. And when that stops, and it is stopping, and the liquidity begins to run dry, we could talk about that in a minute if you want to, I think there could be tremendous problems, because if you reconcile those ratios, you're talking about a 30, 40% drop in home prices, a 50% drop in equity prices. What is that going to do to the banking system? What is it going to do to the economy? And I think you can answer that question for yourself.
The one question that comes to my mind when you say this, and again, this is just thinking off the top of my head, I'd like your comment. At the end of fiscal year 2024, the total government expenditures in the United States, including federal, state, and local spending, amounted to approximately 36.2% of national gross domestic product. Is the amount of government involvement in the economy really making these numbers worse? If we realize that, they really don't contribute very much, and that is 36% of our GDP. Is it even that much worse when we factor that in?
Well, yes, you're 100% correct, Andy. I don't look at it as a percentage of GDP. I look at our debt and deficits as a percentage of our income. Because GDP, you can't, let's just say the government says, oh, it's something I could tax. I could tax GDP at 100% and get that GDP, which is about, our revenue is about $5 trillion a year. You think you can tax all of the GDP to match your obligations? That's not true, because I don't know about you, but would you go to work if you were taxed at 100%? I mean, there might be some people there might be some artists that I can't help but dance. I can't help myself. No, I think I would probably stop working completely.
Yeah, I think I would as well. It's part of the reason I left Minnesota, although it was only 10% tax. It certainly made it a little bit easier to come to Florida and get out of the cold. Well, while we're talking about debt and government obligations,
can I just? I'm sorry to interrupt you.
I'm sorry. Absolutely.
I just want to finish my one. I just want to make this one point. I look at debt as a percentage of as a percentage of federal revenue. Our debt, our national debt, is 720% of our revenue, and that's pretty daunting. I mean, think about if you had a mortgage, it was a $720,000 mortgage and credit card debt, but your income was only $100,000. That would be really daunting. And then you went to the banker and you said, well, listen, the banker says, well, listen, how much of this are you paying off every year now that you've run up this mess? He goes, no. I'm adding 40% of my income to the debt every year. And the banker would laugh, and the banker wouldn't even give you a lollipop on the way out of it. He would just keep laughing at you because it's ridiculous. So we have a solvency issue in this country, and we have an inflation issue in this country that has not been addressed appropriately at all. Sorry for interrupting you.
No, I'm sorry for not letting you finish your thought. My bad. And that's kind of where I wanted to go with this next question. We have $28 trillion in treasury debt that is maturing by 2028. We have a $36 trillion debt that we talk about, and 185 trillion-ish in unfunded liabilities, Medicare, Medicaid, Social Security, government, military pensions. Most people don't understand how big a trillion is. A trillion seconds ago was 31,688 years ago. So I think it's fair to say we're facing a debt spiral. Michael, is there any realistic way out of this, or are we inevitably headed towards some form of a financial reckoning?
I think there's a way out of it, but it's not painless. We should have a reset, really, a reset of the currency and a reset of the debt, like a jubilee. But I just don't think that's going to happen. I think we're going to continue to default on our debt implicitly, which is through inflation. And I think it gets a lot worse after this next recession, which, I don't know when it's going to happen exactly, Andy. I can't give you the date, but I know the business cycle hasn't been repealed. You can forestall the business cycle by printing $5 trillion and handing it out to people, which is exactly what we did. You won't have a recession, but you'll have a lot of problems with inflation. That's exactly what has occurred. Inflation has been, Andy, above the Fed's asinine, and I like to say asinine because it is an asinine target of 2%. A central bank should exist supposedly for the existence should happen because they want to preserve the purchasing power of the dollar and the living standards of Americans. So your inflation rate should be 0, not 2, but it's 2. And they've missed that for 4 years to the north. The average inflation rate that they've said, which is the best rate that this country can survive on, is 2%. If it was 1.9, it would be horrible, but it has to be around 2%. It's been well above 2% for 4 years. And we have a central bank that's thinking about and has been cutting interest rates. Now, I think that's disgusting.
It's stupid. You can't make it up.
And by the way, if you counted inflation the way they did pre-Boskin, the 80s and 90s, when they didn't have all the substitution and hedonics, you're closer to double-digit inflation than you are to 3-something%. In the core, trimmed, mean, blah, 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 you could contort and twist. You're still above 2%. It isn't anywhere near zero. Oh, and here's the biggest point. The inflation that you did create after 2020 has already bankrupted the lower 3 or 4 quintiles of Americans. They cannot afford the level of prices. They can't afford insurance and taxes and shelter and food. You bankrupted them, and now you're saying, well, it's still going higher. It's going higher than our 2% target. It's going, the way we calculate it, 3.3, but in reality, it's closer to 10. And we're thinking about cutting rates, hopefully, this year. What?
It is very silly. It reminds me of the Cantillon effect, where the people closest to the money are benefit disproportionately, and the wealthy have become wealthier because their assets have inflated. And you're right, the bottom half of the financial matrix are struggling just to make ends meet in an inflationary environment. And I agree with you that it seems as though that inflation will be the path that they will choose, as all politicians have chosen before. When we have all of these obligations and not enough revenue, what other choices are there, I suppose, other than default? There are others, and that's, maybe potential others. And I want to mention my interview with Judy Shelton recently and talk to you about that. But before I do, you mentioned this 2% inflation target. And I asked Judy that. I said, Judy, who in the hell came up with this stupidity of 2%? Why not strive for stable prices, no inflation? And I said, who did that? And she said, it's Janet Yellen's husband who came up with it. I didn't even know he was an economist, but and his rationale, she said, was incredibly deceitful, and she rallied against it. And it was that if you have stable prices, well, employees won't get raises very often, and it will make them unhappy. So if you strive for 2% inflation, employees can get a 1% raise. And even though they're actually falling behind, they feel better off because they're getting pay increases. And that was what I'm like, that's the most ridiculous thing I've ever heard. But this is the kind of stupidity that I guess that our Federal Reserve has thought would be the best way to run the monetary policy.
Well, first of all, I doubt it was Janet Yellen's husband, because it's not just the United States that has adopted this 2% target. It's universal. All the developed nations in the world, all their central banks, the ECB, they all say, well, 2% is our target now. What in the world? Why in the world would they adopt this 2% target? But I have a nefarious reason. I have a more nefarious reason why I think they chose 2%. Not for raises. I think they understand. They understand now, after the global financial crisis, the dangers of having banks' assets falter. And banks' assets and shadow banks and primary dealers, they own corporate debt and they own real estate, mortgage-backed securities, residential mortgage-backed securities, and commercial mortgage-backed securities. The way you can destroy the banking system and have a run on banks quickly is to have these assets fall. The assets were elevated to a level that you need a constant flow, like I started this interview out, a constant flow of new money creation pouring into them to keep them growing. And when you have a bubble, you need that constant flow, because bubbles don't seem to deflate nicely. They have in the past always imploded or exploded, whatever the term you want to use. They've crashed violently. They didn't have a gradual, peaceful, or as Ray Dalio calls, a beautiful deleveraging. I've never seen it happen before in my life. And I've been doing this for 34 years. So I think in unison, corporately, the central bankers, that cabal, got together and said, we need to ensure that home prices never fall again. So we need to constantly make sure the inflation rate is increasing by at least 2%. And we'll lie and obfuscate and prevaricate about the reality of this by saying we're going to go from the headline to the core to the super core, and we'll just bastardize the whole thing until we come up with saying trimmed mean, whatever they want to say, that prices aren't going through the roof. And that's exactly what's happened. And they're doing so to keep home prices and stock prices and the bubble economy inflated. That's my view.
That makes sense. You would think it's a daunting task after 20, 30 years of zero-bound federal funds rate. The distortions in asset prices, as rates rise, we may find what the real asset prices are as they find equilibrium with rising interest rates. But it does make sense. I do agree. But I ask myself all the time, what's the housing market worth at 3%, at 7%, at 10%, and on and on and on. I guess real price discovery will rear its head in that environment. Changing gears just a little bit, mentioning Judy Shelton, I thought she was a fascinating interview. She told me that it is her belief, after discussions with Trump in the first administration, of course, she was his nominee for Federal Reserve Chair, wasn't confirmed, may end up finding her way onto the Board of Governors this time, or maybe in replacing Powell, who knows. But she said to me that she believes on July 4th, 2026, the 250th year anniversary of the United States, that he will issue treasuries, 50-year treasuries backed by gold and redeemable in gold to manage the national debt. At the same time, new Treasury Secretary Bissett has said not only is gold his largest personal holdings, but he suggests monetizing the asset side of the U.S. government balance sheet. You mentioned we have about $5 trillion in assets, which is pathetic in and of itself. The largest asset is student debt. Not going to monetize that. Not going to monetize the military, which is number 2. Well, you could monetize land, which is number 3. But you know where I'm going with this, with gold. So what I'm getting at is, do you see a connection possibly between these proposals and these statements and the recent massive influx of metals into COMEX, as well as the shift since November of the U.S. being a net importer of gold rather than a net exporter? Could all of these things be tied together? Could we see gold reintroduced to some degree, which is the only other tier 1 asset in the world, into United States monetary policy?
That would be lovely. First of all, I said the U.S. has $5 trillion in revenue. I just want to make sure, not in assets.
But they only do have $5 trillion in assets on their balance sheet, just over.
Yeah. I mean, total assets are much higher than that, but it's still an insolvent nation if you look at unfunded liabilities minus their assets. But I would, gold. Besant was on TV today, and he was asked this question. Well, first of all, there was a couple of rumors. Gold is very close to $3,000 an ounce, an all-time record high. And I own some in my portfolio. And of course, I advocate that everyone own 5% physical gold in their own possession. But I asked myself, why is gold in this very extended bull market? I think it's one of the best bull markets in history in gold. And I think it's just getting started. But I asked myself this question, why is that so? Because you think about what's going on. Well, interest rates have been rising on the long end of the yield curve, so nominal rates are rising. That's normally not great for gold. The dollar has been in a huge bull market. That's usually not great for gold. Peace is breaking out supposedly all over the world. That's, Ukraine, Russia, and Gaza. That's supposedly not so great for gold. So what's the reason? What's the rationale? And of course, Bitcoin has been stealing a lot of gold's thunder. What's the rationale? So there's a couple of rumors out there. One is that they were going to audit the gold in Fort Knox. And then Besant was on TV today saying that he can guarantee you that all the gold is there. And it isn't gold-plated tungsten. He didn't say that, but I'm adding that. So that was one possibility that was out there. And there's various rumors out there. There's another rumor out there too. It's skipping my mind right now. But maybe it is this simple, and I'll remember it in a second, but maybe it's just this simple, that real interest rates are falling because of precisely what we just talked about, Andy. We just said that the Fed lowered interest rates by 100 basis points since September 18th of 2000, and 24. They started with a panic 50%, 50 basis point reduction. And at the same time, inflation's going higher. And if your interest rates on T-bills and in the money markets is static or going lower, and inflation is going higher, then what is happening with real interest rates? They are falling. And that's always been rocket fuel for gold. So that is probably what's happening. Now, there's other, and I remember the other thing you were alluding to. We were going to monetize gold. I want to talk about this for a second. So the Treasury has supposedly 261 million ounces of gold, valued at $42 an ounce. And if they revalue this gold, it would be like, I think, $750 billion. Now, the gold is the gold. It's there. This is an accounting trick from Treasury. And they can say it's $0 an ounce or $1 million an ounce. The market value of this gold is $750 billion, right? We agree with that, Andy? You're with me so far? Here's where I think Besant and whoever's talking about this falls off the rails. He's talking about monetizing gold. Does that mean you're going to sell your gold and raise $750 billion? I think that would be a terrible move to sell all the Treasury's gold. But they want to do something else, which I think is kind of funky a little bit. They want to monetize this gold by revaluing and say, okay, gold is now at a market price. We're going to value it on our balance sheet, $750 billion. But then magically, that's going to allow the Fed to repo the Treasury's gold and put on the Treasury general account by a couple of keystrokes, making it $750 billion, which the Treasury can then use to pay off debt. That's where I think, just because you revalue your asset doesn't mean you get to magically declare you can create $750 billion and pay off debt and still believe and behave like you have 261 million ounces of gold. But Besant said this morning, he said, that's not what I meant. I didn't mean by monetizing Treasury assets that we were going to revalue gold. Well, what did you mean? I don't know why. He was on a Bloomberg interview, just to be specific. I don't know why they didn't ask him, well, what the heck did you mean by monetizing these assets? I think it's very possible that one of the reasons why gold is in this massive bull market, other than the fact that real interest rates are falling, if you look at money market rates versus, in real terms, versus inflation, adjusted for inflation, is the fact that they're going to perhaps monetize gold by declaring it worth $3,000 an ounce, $5,000 an ounce, maybe much higher than that, much more, maybe $140,000 an ounce, and pay off our entire debt by printing money. Now, that's a very extreme case. I don't think it's going to happen. But could they revalue gold to a fair market value that's north of $3,000 an ounce? Yes, I think they could do that. And that would create a whole heck of a lot of inflation.
You're the first person. I said that I did a presentation at Jay Martin's Vancouver Resource Investment Conference a month ago. And it's on YouTube now. And in my presentation, I said, I'm not saying they're going to do this, but if they put it at 142,000, it would offset the liabilities on their balance sheet. It's ironic that it's held in the account on every central bank balance sheet. The name of the account is the gold revaluation account. And we've been hearing the head of the the members of the Bundesbank and the head of the Dutch National Bank advocate for it, revaluing gold. And of course, even Senator Cynthia Loomis from Wyoming, advocated for it at the Bitcoin meeting in Tennessee to put it to a level high enough to provide money to buy Bitcoin for the strategic Bitcoin account that she's advocating for. Yeah, it's interesting. Guys like James Rickard saying like 24,000, and he uses a 40% gold backing ratio and dividing that into take 40% of M1, take that number, divide it into the gold, and he, I guess, came up with 24,000. It is an interesting thought experiment. I'm not sure what they're planning on doing either, but you're the first person to say that, and I appreciate your open-mindedness. I don't know what they're going to do either, but what I will tell you as someone who's been following the gold market for 35 years, we've seen the largest delivery ever in the history of the COMEX in February of almost 6 million ounces, and there's something going on that's, I think, bigger than just tariffs.
Yes. Yeah. Oh, yes. There's no doubt about that. So there's something else going on. But again, I want to reiterate this one point. And I'm glad you brought it up even before I brought it up about the $142,000 an ounce. You can value your assets any way you want. You can mark them to model, or you can mark them to market. You should mark your assets to market in a fair world. But I just don't understand the nexus between marking gold at $3,000 or $4,000 or $140,000 an ounce and allowing the Fed to print that money and hand it to the Treasury. I don't understand that. They haven't sold their gold. So there's some funny gimmicks going on here. And it's very inflationary. I want to make that point very succinctly. Well, first of all, since we have a maverick and a game changer in the White House, I would, if I had my druthers, I would end the Federal Reserve. There is no way that 12 voting members of the FOMC, Federal Open Market Committee, can divine through omniscience that they think that they have, or pretend that they have, the cost of money. The cost of money should be a function of the supply of savings versus the demand for money. And I would like to see a market rate on that. So here's what I would do. First of all, I would say, okay, thank you for your service. The Eccles building is now locked up. You're going to be part of that, the Doge's efforts to reduce. I think they have and I might be wrong, I think they have 400 PhD accountants, PhD doctorates at the Federal Reserve. 400 people for what? To be data dependent? It's absolutely silly, right? So this is what I would do. If I had my draw, I'm king. You made me king for the day. I would say, okay. So the base money supply, high-powered money, which is what the government does control, okay? So you think about cash and Fed credit. I'm going to make that grow by 2% every year to match population growth plus productivity growth, which is commensurate with GDP growth. 2%. No more and no less, no matter what. So that's the base money supply. And then I'm going to let that savings, that money, that real high-powered base money supply that will be in the banking system, I'll let that rate float vis-a-vis the demand for those loans that are available in circulation, money in circulation versus demand for credit. And there you have a market rate based on a real money supply that's never going to be inflationary. Andy, as you know, I'm not going to reveal anything to you. The Fed's balance sheet was $700-800 billion prior to the global financial crisis, which was 2000. December of 2007 was when the recession officially began. And it went to $9 trillion in 2022, from below $1 trillion to $9 trillion. And the amount of reserves, bank reserves, which, this is bank credit, and there's also, think of it, reserves as, this also can be converted to money, but it's bank credit, used to be from 1913, the foundation of the Federal Reserve, until 2007, we had $50-60 billion, just a couple of dozen billion. Well, that shot up to $4 trillion by the end of 2021. I would, Andy, can you help me get on the panel that asks Jerome Powell questions at the annual Humphrey Hawkins testimony? I would ask questions like, why do we have a 2% inflation target? Well, and you've missed it for 4 years. I would ask some questions like, how the heck did we get from $60 billion in reserves for banks to $4 trillion in reserves? And why the heck are they still above $3 trillion? And why are you only draining them slowly? Why are you talking about stopping that now because of a debt ceiling debate? Why are you destroying this country? This country's middle class has been eviscerated because of the inflation that you created. Andy, there's nothing wrong with disinflation. There's nothing wrong with a little bit of deflation. We've had that in this country before, and it was our shining hour. There's nothing wrong. In fact, deflation is a natural byproduct of being productive. You're more productive. You can sell more whatever widgets, and you can lower the cost, and more people have widgets. That's the natural. That's the way the economy should function. This 2% malarkey, which became, we have 20% year-over-year home price growth appreciation for year after year. And then we have nice, benevolent, altruistic companies like Blackstone buying thousands and thousands of homes and then renting them out to the poor, impoverished middle class. Doing us a favor. They actually were on TV saying what a favor they're doing. Supplying more homes and more roofs over the heads of the population. It's nonsense and it's disgusting, and this has to stop. I'm hoping I'm hoping our new president realizes it and puts an end to it. I have my doubt, but he's the only one I think is even remotely possible of doing it, because he's the only one even talking about it remotely.
Yeah, I would agree. And it almost sounds too stupid to be stupid. Almost sounds like it's planned. I'm not saying that it is, but to your point, I looked it up. 400 PhD economists among its 500 researchers. Additionally, each of the 12 regional Federal Reserve banks has its own team of economists and research analysts. You had all of these thinkers, and they can't get it right even by a country mile. It is shocking, actually, when you phrase it that way, when you frame it that way.
Yeah. Well, there's some savings right there. There's some low-hanging fruit right there. Goodbye.
Yeah, absolutely. I think I know your answer on this, but I'd like to hear your take. Digital assets, cryptocurrencies, do they have any place in any investment portfolio that you're managing or advising, or do you think the risks in this case massively outweigh any potential rewards?
The short answer is no, and in all candor, it's been no forever for me, which has been the wrong answer. The direct answer should have been yes. I think in a world without a Wall Street, they do have a place, but the price of Bitcoin, let's say Bitcoin, for example, at $100,000 a unit is ridiculous and should be eschewed at all costs, in my opinion, especially for me and my clients. That's a no touch for me, because this asset, cryptocurrencies, has value in the fact that by nature they should be, or at least Bitcoin should be, immutable and decentralized and anonymous, the transactions thereof. But when Wall Street gets, when you buy a Bitcoin ETF and you think I'm a crypto baller, I got exposure to crypto. Well, the allure of crypto is that it's decentralized and nobody knows what you're doing. It's an asset that no one knows you have, and you could buy things anonymously and in a decentralized nature. But when you buy it through a Bitcoin, everybody knows through an ETF. Everybody knows who you are, because you can't buy it because you have KYC laws, know your customer laws, and anti-money laundering laws. They all know who you are, and therefore it can be taken from you. But Wall Street got involved and co-opted the whole, cachet and allure of cryptocurrencies were that they were anonymous, but now it's no longer the case. So the price has been warped and deformed to a level that is no place in anybody's portfolio at these levels, in my view. And I want one more comment just to annoy everybody in the cryptocurrency crowd, there's a limited amount of gold which came from exploding stars in the Earth's crust. Okay? There's a limited amount. And it has value because it's very beautiful, it's very rare, and it's virtually indestructible. And there's only a very small number of elements that meet that criteria that I just mentioned. There is, conversely, an unlimited amount of blockchains that can be created, which supposedly serve the same function of moving a coin along this digital ledger. So while Bitcoin has rarity in its 21 million units that can be mined, but how many units are there of Ethereum and Bitcoin Cash and Dogecoin and Melania Trump coin and Fart coin? So it's commensurate with me saying that if they were discovering new elements in the Earth's crust that were very beautiful and extremely rare and virtually indestructible, even though they weren't gold, they would attenuate the value of gold because they serve the same purpose. Do you see what I'm saying?
Yeah, absolutely.
So cryptocurrencies are not digital gold. They never will be. And their price has been bastardized by Wall Street, in my opinion, and I have been dead wrong.
Well, I thought the prices were bastardized when the Comex created a contract on it to begin with, and then you end up throwing in the ETFs and financializing it the way that they are. I find your take to be quite logical, actually. I was just curious as to how you felt about it, and for me, it's almost. Richard Russell, in many ways, was my mentor, said if you make 7% a year, you go into the Hall of Fame of investors. And yet we've created a whole generation of investors who also believe that if you're not experiencing annual triple-digit gains, that they have no use for it. This is why gold has been unrecognized, and yet it's doubled the performance of the 10-year Treasury for 25 years and continues to march higher at roughly 9.9% compounded per year. And doesn't get noticed whatsoever. I find that interesting as well. And yeah, it is an interesting thought to think, what would Bitcoin be if it weren't for MicroStrategies and the ETFs that have, I guess you could say, certainly inflated its price for
It
sure.
would be $100,000 a unit. I can tell you that.
Right. No, that's an interesting point. Last question, Michael. I appreciate your time. And before I ask you how people can find out about you, the question is, just to give, kind of your macro perspective, if you were going to write a book today about the current financial landscape and where you think it'll be in the next 20 years here in the United States, and this may be unfair, what would be the title and what key message would you want to convey?
Well, I mean, I don't know about the title. I will tell you this, that the risk reward for being overexposed to equities right now is the lowest I've ever seen in my 34 years of being a licensed professional. If you look at things like the CAPE ratio, if you look at the median PE ratio, if you look at the total market cap of equities to GDP, price to sales, the risk premium being negative, going out 10 years, the average return has a minus sign in front of it. That doesn't mean that every year it's going to be a minus sign. What I do believe, it's a tremendous opportunity, because I think you're going to have one year where it's down 30% or 50%, or several years down multiple double digits down, and then bottoms out and then makes a huge rebound as we start this massive period of what I think is going to be intractable stagflation. Remember, in Weimar Germany, prices went higher. In real terms, they got destroyed, but in nominal terms, they went higher. So I think we're headed for something like that before we do this grand reset. But maybe the title would be Prepare for Reality. Because like you said, very astutely, the zeitgeist that's been inculcated to investors over the decades is buy the dip, buy the dip, buy the dip, the Fed's got your back. The Treasury's got your back. And now investors are spoiled if they don't get double-digit returns every year. And everybody's crowded into the same trade. You have this buy and hold mentality. You've got these target date funds. You have very little protection. You have, overnight options. You've got leveraged ETFs. The carnage that could occur in a very short period of time is immense. And if you didn't have, I have created an algorithm, a model called the inflation, deflation, and economic cycle model. It allows me to participate in this lunacy, but I understand and measure and map the arcane components of the market that lets me know when it's time to head for the emergency exit quickly. So I'm going to continue to, I'm still long. I have about a portfolio that's about 20% long, the stock market. But it's not in those crowded trades. It's not in the Mag 7 where everybody, owns. So it's in more of a defensive posture. But I'm still long. I have some gold in the portfolio. I have inflation hedges in the portfolio. But I'm not short any equities at this point. I have an anti-beta ETF, but I do not own any straight shorts in the portfolio other than a short and high yield, which in all candor has not been working. But and the spread between high yield and treasuries cannot get any more thin than it is now. It just can't happen unless you're going to tell me that you're going to pay more for a corporate. You're going to accept a lower rate of inflation, lower rate of interest on a corporate bond than you do from a treasury, which I guess is possible, but really highly unlikely.
Doesn't make holding
a whole lot of sense.
Risky corporate asset very appealing in that respect.
So I think what I'm trying to say, and I hope I make this very clear from anybody listening to this, and I know it's going to sound self-serving, but it's absolutely the truth. You have to have an active management strategy that includes alternatives in it if you're going to protect and profit from what I see coming, not just what I see coming, but what history shows happens to the stock market when you have this level of asset bubbles.
Well, and I respect that. That's one of the reasons I respect you and have listened to you for so long, because I mean, I guess if I were going to just say it flat out, you're someone who's found success in the traditional investment world, yet you acknowledge the problems. And it's funny what you said. I live in a golf community in Florida, and guy across the street from me, the only time he ever talks to me about gold and silver, he yells at me from across the street when it's down. Oh, I see gold's down. I mean, I want to punch the guy. But he said to me, we went out to dinner one night with our wives, and he said to me, when the market falls, I just double down. It's always worked. And he's in the Forbes top 40 list for financial advisors. He manages $3 or $4 billion here in Florida. And he more or less said exactly what you were saying. I always double down. And he said, people who sold in 2008, well, they were stupid because it came right back. But he won't acknowledge the fact that the Fed's balance sheet went from 800 billion to 9 trillion along the way. So you're right. I think there are a lot of people in terms of money managers who will just lead their people to slaughter. I like the fact that you have a much more diverse macro view on things and aren't a permeable. And I guess it would be easy to be one in the money manager world where interest rates have fallen since 1982 until just recently at a 45-degree angle, making that profession, very lucrative and very successful. I admire that about you. And with that said, how can my listeners find out more about you and actively perhaps even take part in what you're doing in your management?
Well, before I answer that, you see me just 30 seconds. I just want to say that I also live in a golf and country club in Florida, and one of my residences. And I am often derided, affectionately, I hope. Just go along the S&P 500. That's all you need to do. Because of what you said and what I said, the Fed and the Treasury will always bail you out. that's a recency bias there that has been the case since like 1987. If you look at other countries, let me give you two examples of why it always comes back right away, doesn't really work. And that, of course, Japan, 1989, in nominal terms, is still below where it was in 1989. The Shanghai Composite Index is still about half where it was in 2007. But why is it different? Why could it be and should it be different this time, Andy? If we have a recession and the Fed starts printing money and starts handing checks out to people through the Treasury and they monetize it all, why could it be different this time, at least for a longer period of time before the market comes back? What do you think is going to happen to interest rates if they start doing that again?
They have to go up.
They have, I mean, you know that inflation, the way they measure it, went to 9%. In reality, it was closer to 20. I think inflation will go the way they measure it well into the double digits. In reality, it could be, 20, 30%. Where does the interest rate complex go? The long end of the yield curve, and that includes also in corporate debt and mortgage-backed securities. What happens to those rates? They go much, much higher. And if that's the case, what happens to bank assets and what happens to the stock market? Does the stock market go up in the face of a 20% 10-year bond?
There's no way.
I'm asking questions.
That almost sounds like the Great Reset. Stocks, bonds, real estate, the banks, the insurance companies, they're all inversely correlated to that. That would be a very dangerous environment. That would be very, very dangerous.
So two things. And again, this is the last thing I'll say. Two things have changed because I try to explain to people who affectionately deride me when I say the stock market is vulnerable.
I would never do that.
Because we have two new things have occurred since the last crisis. We have a problem with inflation, and we have an insolvent government. Those are two new things. And when you borrow, if you borrow trillions of dollars again and monetize it again, you exacerbate those two conditions, thus sending yields much, much higher. Unless, of course, the Fed decides to put a cap on the 10-year note. But then are they going to cap corporate bond rates, corporate bond yields too? I mean, municipal bond rate? I mean, they're going to buy every fixed income asset? I don't know. Maybe they will. And destroy the country. But that's where I'll leave it. So don't be so placated and say, oh, it always comes back. Now, I know you didn't say that. But people have been inculcated through the years. And it's not always hasn't happened that way in the past. Always. Took 5 years for the market to come back, by the way. It took 15 years when it blew up in 1929. So the market doesn't always just bounce back right away. And this time could be much more difficult. So if you want to listen to my podcast, it's the Midweek Reality Check. There's a 5-week free trial. If you like it, it's $50 a year. You get a lot of my thoughts. If you have $100,000 to invest and you're a U.S. citizen and you meet our criteria for investing, if you're suitable for the portfolio, because it's an alternative portfolio, I think it's a safer portfolio, but the fact that I can own lots of cash and buy things like gold, it's called an alternative portfolio. I will take your money and invest it for you in the inflation, deflation, and economic cycle model, which looks at the second derivative of inflation in the context of growth to keeps us in the right sectors and bullish when we need to be bullish and bearish when we need to get bearish.
Well, I'd rather have my money managed by someone who has a broader view and understanding rather than someone who thinks it always comes back. And I learned that real early, Michael. I came into this industry when the Japanese Nikkei was nearly 41,000 in 1989, and it just recently got back after 35 years to where it once was. To your point, it can take a generation to come back. I think that's a very astute point, and I hope my listeners will take advantage of your services. Certainly. You seem to be someone who would be worthy of helping people navigate these daunting and very challenging times. The Chinese curse, may you live in interesting times. These are very interesting, to say the least. I really enjoy your perspective. I thank you for coming on. It's nice to hear from someone and their perspective who, again, I don't call you mainstream, but you have found success in equities, in managing money, and yet you understand the other side of the table. To me, that makes you a very, very suitable, well-rounded person who would be top of the list for managing my money in a very challenging environment. So anyways, thank you for being so candid and for jumping on. I hope to do it with you again sometime soon. And I just wish you all the best and look forward to picking up where we left off.
My pleasure, Andy. God bless.
God bless you too, brother.
Thank you.
Little by Little with Andy Schechtman.